Imagine you were standing at the edge of a wide river. You need to cross it, but the water is moving fast and the weather is unpredictable. You could jump in and hope for the best, or you could plan. You might look for a bridge, wear protective gear, or wait for calmer conditions. That moment, choosing how to deal with uncertainty, is the essence of risk management. In business, finance, investing, and even everyday life, risk is unavoidable. Prices change, markets move, interest rates rise and fall, currencies fluctuate, companies succeed or fail. The goal is not to eliminate risk entirely, because that's impossible, but to understand it, control it, and prepare for it. In this audiobook, we'll explore what risk really means, the core principles of risk management, different types of financial risk, and most importantly, hedging strategies, tools designed to protect against losses when things don't go as planned. This journey does not require advanced math or technical expertise. Think of it as learning how to build a financial safety net, one thoughtful step at a time.
Chapter 1. What is risk? Risk means not knowing for sure what will happen in the future. For example, when you invest money, you cannot be sure if it will increase or decrease. When a company borrows money, it cannot be certain it will earn enough later to repay the loan easily. When a farmer grows crops, the weather might help or harm the harvest. Risk itself is not a bad thing. Taking some risk is often necessary to grow, earn money, or improve life. Higher rewards usually come with higher risk. Problems arise when risk is not clearly understood, completely ignored, or too big to handle if something goes wrong. This is why risk management is important. It does not remove uncertainty, but it helps people prepare, protect themselves, and make smarter decisions so that unexpected losses do not cause serious damage.
Chapter 2. The purpose of risk management. Risk management means finding risks, understanding how serious they are, and controlling them in an organized way. The goal is not to predict the future perfectly. Instead, risk management helps answer 3 simple questions. What might go wrong? If it goes wrong, how serious could it be? And what can we do now to reduce the damage? Good risk management helps people and organizations avoid sudden and heavy losses, keep income and expenses more stable, protect their money and resources, make better decisions, stay confident even when situations are uncertain. Think of risk management like wearing a seatbelt. You don't expect an accident, but wearing a seatbelt protects you if something unexpected happens.
Chapter 3. Types of financial risk. Simple explanation. To manage risk well, we must first understand the different types of financial risk. 1. Market risk. Market risk is the chance of losing money because market prices change. Examples include stock prices going up or down, bond prices changing when interest rates move, prices of oil, gold, or food changing, markets becoming unstable or volatile. If the value of your investment depends on the market, you face market risk. 2. Interest rate risk. Interest rate risk comes from changes in interest rates. It affects bonds, loans, mortgages, savings, and investments. When interest rates rise, bond prices usually fall. When rates fall, loans become cheaper, but savings may earn less interest. This risk is especially important for banks, governments, and companies that borrow large amounts of money. 3. Currency or exchange rate risk. Currency risk happens when money is involved in more than one currency. For example, A company earns money in one country but pays expenses in another. An investor buys foreign assets. A person travels or studies abroad. Changes in exchange rates can increase costs or reduce profits. 4. Credit risk. Credit risk is the risk that a borrower may not repay money they owe. This affects banks giving loans, investors buying bonds, businesses selling goods on credit. Managing credit risk means checking how reliable borrowers are and limiting how much is lent to them. 5. Liquidity risk. Liquidity risk occurs when an asset cannot be sold quickly without losing value. An investment may seem valuable, but if you need cash urgently and cannot sell it easily, it becomes a problem. 6. Operational risk. Operational risk comes from internal failures or external disruptions, such as system or technology breakdowns, human errors or fraud, poor processes, supply chain disruptions. These risks can interrupt normal operations and cause financial losses.
Chapter 4. The Risk Management Process. Risk management is done step by step. First, risks are identified by thinking about what could go wrong and which areas might be affected. This could be anything from falling prices to system failures. Next, these risks are assessed by asking how likely they are to happen and how much damage they could cause. This helps decide which risks need the most attention. Then comes the response stage, where a decision is made on how to deal with each risk by avoiding it completely, reducing its impact, transferring it to someone else, or accepting it while being prepared. Finally, risks are continuously monitored because situations change over time. Risk management is an ongoing process, not a one-time activity. Chapter 5. What is hedging? Hedging is a way to protect yourself from losses by taking an opposite position to your main risk. It works much like insurance. You pay a small cost now to avoid a much bigger loss later. The main goal of hedging is not to earn profits, but to reduce uncertainty and protect against unfavorable outcomes. Even though a hedge may limit gains, it provides safety and peace of mind. Chapter 6. Why hedging matters. Hedging is important because it helps reduce sudden changes in income or asset values. It makes earnings more stable, protects against extreme losses, and allows better financial planning. However, hedging is not perfect. It costs money, may reduce potential profits, and requires careful planning. The real aim of hedging is balance, not eliminating risk completely. Chapter 7. Common hedging instruments. There are several tools used for hedging. Forward contracts allow buyers and sellers to fix a price today for a future transaction, helping protect against price changes. Futures contracts work in a similar way but are standardized and traded on exchanges. Options give the right but not the obligation to buy or sell at a certain price, limiting losses while keeping the chance for gains. Swaps involve exchanging cash flows, such as interests or currencies, and are mostly used by large organizations to manage long-term risks.
Chapter 8. Hedging market risk. Market risk is managed mainly through diversification and financial instruments. By spreading investments across different assets and sectors, losses in one area can be offset by gains in another. Investors may also use futures or options linked to market indices to protect their portfolios. Diversification remains one of the simplest and most effective ways to manage market risk. Chapter 9. Hedging interest rate risk. Interest rate risk affects loans, bonds, and investments. Companies manage this risk by using interest rate swaps, choosing between fixed or floating interest rates, or adjusting how long their investments or debts last. The goal is to match interest payments with cash flows so that rising or falling rates do not create financial stress. Chapter 10. Hedging currency risk. Currency risk occurs when money is earned or spent in different currencies. To manage this, companies use forward contracts and options to lock in exchange rates. Some businesses also use natural hedging by matching income and expenses in the same currency. This helps protect profits from sudden changes in exchange rates. Chapter 11. Hedging commodity risk. Commodity prices can change quickly and unpredictably. Producers and consumers hedge these risks by locking in prices in advance. This helps stabilize costs and protect profits. A well-known example is airlines hedging fuel prices so that sudden increases do not sharply raise operating costs.
Chapter 12. The cost of hedging. Hedging involves fees, premiums, and the possibility of missing out on higher profits. It also requires time and expertise to manage. The key consideration is whether the cost of hedging is lower than the potential loss from not hedging. In many cases, protection is worth the price. Chapter 13. When hedging goes wrong. Hedging can fail if it is poorly planned or misunderstood. Instead of reducing risk, it may increase exposure or create a false sense of safety. To avoid this, hedging strategies must have clear goals, be properly measured, and be regularly reviewed. Good hedging requires discipline and awareness. Chapter 14. Risk culture and decision-making. Risk management works best when supported by a strong organizational culture. Healthy risk cultures encourage honesty, careful decision-making, and learning from mistakes. They avoid unnecessary risk-taking and prepare for uncertainty. Risk management is not only about tools, it is about attitudes and behavior. Chapter 15. Risk management in everyday life. Risk management is not limited to businesses and finance. People use it daily by saving money for emergencies, buying insurance, planning careers, and managing time wisely. Understanding risk helps individuals make better choices and handle uncertainty more confidently in both financial and personal life.
Conclusion. Risk is an unavoidable part of life, business, and finance. While it cannot be completely eliminated, it can be understood and managed in a smart and practical way. Through risk management, individuals and organizations learn to identify possible problems, evaluate their impact, and choose appropriate actions to reduce potential losses. This structured approach helps create stability, protect resources, and support better decision-making even in uncertain situations. Hedging plays a key role in risk management by acting as a form of protection, much like insurance. Although it comes with costs and may limit potential gains, hedging provides safety against unexpected and extreme outcomes. When used carefully and thoughtfully, hedging reduces uncertainty and allows individuals and businesses to plan with greater confidence. Ultimately, effective risk management is not just about using financial tools, it is about developing the right mindset. By accepting uncertainty, preparing for possible challenges, and making informed choices, people can turn risk from a threat into a manageable part of progress. This balanced approach leads to long-term stability, resilience, and sustainable growth.